Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to talk about the energy transition, some oil, some Canadian home buyers. I threw that in there because some people wrote in the comment section that I should do a little clip on Canada's real estate market. So I'm going kind of back and forth. It's an energy with a little bit of Canadian real estate thrown in the mix in this one, but it's mainly energy driven. I like researching energy type stuff. And that's kind of just where I naturally migrate to. And the reason I migrate to it is because I think the biggest opportunities for the next decade is in energy. And if we have energy shortages, I think everything else kind of becomes a tough sell because I don't think they'd be as good of an investment if you're energy constrained. So you kind of have to be looking at energy. And I think the biggest opportunities are in energy coming up, especially with the transition from fossil fuels to something else and what could happen in between that transition, basically it being botched. So let's dive in here. I'll show you some articles I've been reading. It says, is the energy transition moving too quickly? The Rice University housed think tank warns that current projections regarding the viability of renewables and electric vehicles largely ignores their true environmental costs. With alternative energy sources not yet able to sufficiently substitute, consumers all over the world would feel energy price pain on even basic necessities such as food. Researchers warn that a push to defund fossil fuels too rapidly risks destabilizing a global energy, food, water, human well-being nexus that, sufficiently perturbed, would likely delay energy transition efforts for decades. For decades. One thing I wanted to touch on here, it says, the fellow in Energy, Minerals, and Materials warns that a premature transition would result in consumers across the globe feeling energy price pain on even basic necessities such as food. The study notes that past energy transitions, such as from wood to coal and from coal to oil, took decades to come to fruition and involved moves from less energy-dense sources to more energy-dense sources. That is not the case with the current energy transition, which proposes a rapid move from high-density to low-density energy sources. Given that in other realities, the author warns that a negative human and economic impacts from government and investor efforts to force the transition too rapidly risks destabilizing a global energy, food, water, human well-being nexus that, sufficiently perturbed, would likely delay energy transition efforts for decades. The authors also note the role that natural gas generation plays in providing backup capacity for wind and solar installations on the world's power grids. Along with that reality, even with battery backup, global natural gas generation capacity will, of necessity, have to dramatically increase along with new wind and solar. This is far from the delete and replace trade-off regularly advertised by proponents of the energy transition. So they're obviously saying that we're going to have to build a lot more and use a lot more natural gas if we want to ramp up our wind and solar. In the lower right, it says, materials intensity associated with energy transition technologies like wind, solar, battery storage for grids, and battery EVs exceeds that of conventional technologies because of lower energy density. In fact, the pronounced trade-off between energy density and materials intensity represents an enormous gap in energy transition thinking, analysis, and policy making, the authors report. They're just saying, to sum this up, if you botch this transition, it's going to hurt a lot of people. And that hurt is going to prevent the transition from happening. It's going to delay that transition for many decades. Another thing that they touch on that I really like is we are switching from a high energy dense source to a lower energy dense source. That's going to be a very difficult transition. It's going to take a very long time because we've always gone up the energy ladder, so to speak. This one, we're actually taking a step back, which means we have to implement far more energy gathering systems to replace less fossil fuels, if that makes sense. And then he also talks about the mineral density and how we're going to have to mine a lot more minerals for solar and wind that's coming up. On the right-hand side here, I'm going to scroll over to the right. What I've got here is the oil. So this is the US Big Three: crude plus gasoline plus distillate inventory deficits to the 4-year 2016-2019 average. And look where we are. We are accelerating this inventory deficit. So we're eating into inventories at ever faster paces than ever before. Pretty scary if you think about it. And this is for all three. The U.S. crude oil inventory deficit to the 4-year average. We had some deficits back here. We had a large surplus in 2020, and we are just ripping the deficits now with greater and greater deficits. So as we go on by, the deficits continue to get larger. We're continually eating away at inventory at faster paces. Moving on down here, I've got an oil rally to continue in 2022 as demand outstrips supply, analysts say. Oil prices rose 50% in 2021. JPM expects oil prices to overshoot to $125 this year. Some OPEC producers are struggling to raise supply. And then OPEC doesn't want oil at 100. Omni Oil Minister. I'm going to go to the left and kind of swap back and forth here. Canadian home buyers face record listings shortage to begin 2022. And I know I'm throwing this in there because a lot of people wanted me to put this in there, so I'm bouncing back and forth. It says statistics released today by the Canadian Real Estate Association show national home sales remained historically high in December of 2021, as the end-of-month supply of properties for sale hit an all-time low. Their inventories are drained up in Canada. So the highlights here is the national home sales inched up 0.2% on a month-to-month basis in December. And remember, that home sales is probably limited by how much inventory they have. The actual not seasonally adjusted monthly activity came in at 10% below the record posted in December of 2020. The number of newly listed properties fell 3.2% from November to December. The home price index rose 2.5%. Month over month, it rose 2.5% and was up a record 26.6% year over year. The actual national average sale price posted a 17.7% year over year gain in December. Massive monster numbers, guys, with Canadian real estate. It says there are currently fewer properties listed for sale in Canada that in any point on record. So unfortunately, the housing affordability problem facing the country is likely to get worse before it gets better. Policymakers are starting to say the right things, but now they have to act to change this course we're on. An aggressive national push to build more homes is what will address the issue, but it will probably have to be greater amount of building than anything we've ever undertaken. A touch over the status quo won't cut it. So one thing I want to pop in here is Canada, they're going to have to push more new home builds, and they're taking on a monumental effort on how many new homes they have to build. And what have I been saying on the channel? More new home starts with more new loans against those homes means greater rates of inflation. So more than likely, Canada is going to experience greater rates of inflation than they have in the past, given where they are in their real estate cycle and the housing starts that they're going to have to build to fix the supply-demand imbalance that they have. Scrolling on back, Goldman Sachs sees a decade-long bull market for metals. Goldman Sachs sees 2022 as the start of a metals supercycle that will last for decades. The biggest beneficiary of the commodity supercycle across the board is metals, says Goldman Sachs, with analyst Jeffrey Curry comparing metals to the oil in the 2000s. And copper may be the new oil. Not only is it offering a brilliant potential setup for returns, but it's also emerging as what could be one of the best hedges against growing market volatility. Why? Because it's indispensable in global decarbonization strategies. And the squeeze is already being felt, alongside record high prices that have seen base metals across the board double from a year ago. So Goldman Sachs sees copper as a very good investment opportunity, and so do I. I'm a huge copper bull. Looking down here, what we have is White House. No oil producer should hold back supply as oil hits $90. Go White House. It's like you produce oil or something. So what they say is nobody should hold back supply at the expense of the American consumer, particularly as the recovery from the pandemic continues. And oil producers around the world have the capacity to produce at levels that match demand and reduce the high prices. That is what we are going to continue to convey. How does she know that? Jen Psaki, or whatever her name is. How does she know that they actually have capacity? Does she know the capacity that the Middle East has? And why should or shouldn't they pump that? I mean, why should she determine if they pump it or not? I'm just asking questions. It says that means responding to any sign of manipulation in the oil commodities market or gouging at the pump, the press secretary added. We've got higher oil prices not likely to lead to runaway inflation. Are you sure about that? So what we've got is Cathie Wood is saying that higher oil prices are not likely to lead to runaway inflation. Oil prices are still trading near 7-year highs, and the Biden administration is feeling pressure to lower inflation. Cathie Wood of ARK Invest is predicting that advances in technology will push productivity higher, helping to bring inflation in check. While climbing oil prices and inflation were once closely related, the correlation between the two has been steadily falling since the 80s. Maverick stock picker Cathie Wood of ARK Invest has told a webinar that advances in technology will likely push productivity rates higher, outweighing any gains in wages. We have a very strong point of view that productivity gains we will witness over the next 5 to 10 years will be astonishing. We think productivity will increase 5% plus, and we won't have an inflation problem, she said. Wood reminds one of the few prominent fund managers who say that deflation rather than inflation will be a driving force in the U.S. economy and stock market over the next few years. ARK Invest has become famous for being something of a contrarian by betting on high valuation, high growth stocks that soared during the early stages of the pandemic. Indeed, the ARK portfolio appears vulnerable to further declines in tech valuations due to its overweighting in high multiple stocks. They say growth is likely to slow abruptly in 2022 as fiscal support fades and in the near term, virus spread weighs on services spending and prolonged supply chain disruptions. Q1 growth is likely to be particularly soft because the fiscal drag will be accompanied by a hit from Omicron. Goldman economist Ronnie Walker has said in a note for clients. Cathie Wood thinks that inflation and deflation, what is being measured, her viewpoint is vastly different than mine. I view inflation as money coming into the system. She views inflation apparently as consumer price index. I don't think that technology can fix a problem with money coming into the system. The way that you fix that is you'd have to completely design a new system because we have too much debt in the system. Inflation is needed for the debt and the system in order to survive, in my opinion. So by looking at the same problem, we have very different viewpoints on what inflation and deflation really are. Technology cannot create deflation. At least in the terms of how I define it. Deflation is a credit destruction in the system. The way it could do it is if you were to lower home prices, new homes being built, and your loaning into the system collapses. The problem with that is the destruction of credit, or I shouldn't say the destruction of credit. It would be a destruction of credit because homes get priced at the marginal home. If you had the home prices all collapse, so to speak, all the banks and your entire system would collapse. So in a deflation, you could have prices go down, but you wouldn't have deflation. You'd have lowering prices of certain things, but you could still have money coming into the system from the loaning against new homes being built and the increase in home prices. So the way that you could disrupt everything would be to completely destroy the home prices, where home prices, new homes being built come on far cheaper. Then you couldn't have your loaning volume keep up, and then your entire system would collapse because it's a debt-based system where there's too much interest payments in the system and not enough base money. So this has to continually expand and grow for the system to survive the way that the money system is is designed. That's my opinion. Looking over to the left here, we've got the lone bear calling for $65 oil. I wanted to touch on this to see what their viewpoint is. It says the head of commodity analysis at Citigroup believes that there has been a colossal failure when it comes to analyzing the fundamentals of today's oil markets. While plenty of analysts are calling for $100 oil, Citigroup sees oil prices falling to an average of $65 a year. Ed Morse believes the current undersupply is a seasonal phenomenon and sees the global oil balance moving back to surplus in the second quarter. Bullishness across commodity markets is overwhelming. Goldman's Jeffrey Curry summed it up earlier this week by saying this is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, aluminum, you name it, we're out of it. Yet there's the occasional bear. And in oil, one bear is arguing, one bear, that oil will fall in just a few months. I think there's been a colossal failure of the analytical community to look at what's happening on the ground, to look at projects that have been reaching final investment decisions, to look at where the efficiency of capital is, to be blindsided by a prejudice which says not enough capital is being spent and decline rates are going up. According to Morse, the team's projection for this year, global oil supply should increase by 5.5 million barrels per day, and this is excluding Iran, which seems to be nearing a chance to return to global oil markets. It is the ongoing talks about the nuclear program with the United States ends with an agreement, as Bloomberg's Xavier Blass noted in a recent column. Iran may be exporting oil illicitly, and lifting the U.S. sanctions may not change from amounts much. But the very news is will be very bearish for oil prices. He says the global head of market analysis at Vitol, for example, recently said the commodity trader expected OPEC spare capacity to thin further this year until the only untapped spare capacity in the cartel remains in Saudi Arabia, while global demand continues rising. So this is another viewpoint in that same article, guys. Demand is 100 million barrels a day with a spare capacity of 2.5 million. That doesn't sound like an oversupplied market, does it? The city's Morse, however, says the undersupply is a temporary affair brought on by seasonal factors. We see the near-term tightness as a winter phenomenon and see global oil balances moving back to surplus in the second quarter, he said, as quoted by Bloomberg. But Blass also wrote it, when everyone is bullish, I get twitchy. I imagine someone somewhere quietly selling, and that contrarian strategy proving to be present in some dramatic way. Call it the oil version of The Big Short, the book and the movie about the 2008 financial crisis. We touched on some bulls, we touched on some bears for oil, we touched on Canadian real estate. What is my opinion on oil? There's tricky things here. The bear, and a lot of bears do this, and I've seen this a lot. What they do is they create a story. They say, I've got some data here. And this is what could potentially be coming. So what they're doing is they're trying to predict the future. And predicting the future is very tough. And a lot of the times I try not to predict the future. What I stick to are the ratios of what's cheap, the market conditions, which is favoring commodities. Then I start to look at inventories. And the reason I put a bearish call here is if I were to scroll back up, this is your inventory of oil here. I can't go that far in. This is your inventory of all these in here. And we've been running deficits, which means we are eating into our inventories at ever greater quantities. And this is accelerating to the downside. Now, I can't tell you exactly what's going to happen in the future, but I can tell you this. If you're eating through your inventories, I wouldn't be a bear at this time. Your inventory is dropping and we're eating through inventories. Spare capacity is very thin. And whenever OPEC says they're going to produce more oil never comes. So I am not in the bear camp because I can't be. And the reason I can't be in the bear camp, because when I look at inventory levels, that one on the left right there, that one right there, up there, right? It's declining, and it's declining quite rapidly. That, to me, says bull. Now, Will this thing turn on a dime and move back up the inventory levels? I don't know. We'll have to see. But right now, the trend in inventories is a deficit. And I probably wouldn't do anything until we see this trend reverse. And again, the inflation coming into the system, the increase in demand for oil coming from other commodities that we are short in, I think is going to consume more oil. So I still think that we are going to have a very large move in oil to the upside, not the downside. I am not a bear at this moment. Our inventories are getting eaten up. Our spare capacity is very thin. I remain to be a bull until the housing starts declines in America, because these things are priced in dollars. And if more dollars are entering the system and more dollars are about to seek assets and commodities, I want to be in those commodities, especially if we see interest rates rise to get this rotation going. So I can't be in the bear camp. I completely understand how a lot of people are very bullish on oil. And some people, the money's never going to rotate in from some groups based off of whatever measurements they have in their thing. Maybe it's ESG measurements where they're supposed to put money in ESG type investments or whatever it is. They can do whatever they want. It's not my money, but this is what's been sustaining life on Earth is oil. This is our high energy dense source. There's a few other sources like natural gas, coal, and uranium that have done very well for humankind. I will continue to be long until I see a viable alternative that works and sustainably works. I struggle to see how all of us are just going to have solar panels and wind turbines everywhere. I just don't think we have the minerals to ramp it that much. Going to a lower energy dense source and having all these minerals just absolutely poking holes in the earth to make it happen. I just don't see that future materializing, at least not anytime soon. So I remain a bull. I still think we're going higher. I think that there could be problems in the second half of the fourth quarter. Second half of the year of 2022 is what I was going to say. Fourth quarter especially, and first quarter of 2023. And we'll see how it plays out. We can just continue to watch the inventory numbers and see what inventory does. I will be consuming far more oil coming up this spring and summer than I would be in the winter. That's me personally. I think a lot of people are like that, and we'll see what happens here. If you guys like the content, give me a thumbs up, subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.